Tesla just dropped a Q3 earnings report that sent shockwaves through the entire stock market. Despite all odds, they beat Wall Street's expectations and the stock soared by a staggering 17% overnight. But here's the real kicker. This might just be the start of something much bigger. Stay with us as we dive into why Tesla's Q3 performance could mean we're about to see one of the most explosive stock surges in recent history. Trust me, you don't want to miss what's coming next. Alright, let's break down Tesla's jaw-dropping Q3 earnings report and see exactly what has everyone buzzing. First up, Tesla's earnings per share came in at 72 cents, well above Wall Street's prediction of 58 cents. For context, that kind of earnings beat, especially in today's volatile market, signals serious strength, and investors noticed, with the stock jumping 17% almost instantly. Now, while Tesla's revenue didn't quite beat expectations, landing at $25.18 billion versus the anticipated $25.37 billion, it's still an 8% increase from last year's $23.35 billion in the same quarter. Even though revenue was slightly below predictions, this growth, especially in a challenging economic climate, shows Tesla's ability to adapt and keep expanding. Here's where it gets even more interesting. Tesla managed to increase its net income to $2.17 billion, up from $1.85 billion a year ago. This means Tesla isn't just growing in revenue. It's becoming more profitable, which is exactly what investors want to see. One of the most surprising boosts to Tesla's bottom line came from $739 million in regulatory credit revenue. For those who don't know, regulatory credits are essentially permits automakers need to offset emissions. Since Tesla produces only electric vehicles, they have extra credits to sell to other car companies who can't meet their emission targets. This isn't just a small revenue stream. It's a major contributor to Tesla's profitability, especially as the competition scrambles to catch up in the EV market. The automotive segment, which is Tesla's core business, pulled in $20 billion in revenue, up from $19.63 billion last year. This is a big deal, as it shows Tesla's vehicles are still selling despite fierce competition and economic headwinds. But that's not all. Tesla's energy generation and storage business, which includes products like their Megapack utility-scale batteries, saw revenue soar by an incredible 52% to $2.38 billion. This explosive growth shows that Tesla is more than just a car company. It's rapidly expanding into the broader energy sector, which could be a game changer in the long run. And finally, Tesla's services and other revenue, which includes non-warranty repairs and services, surged 29% to $2.79 billion. This growth highlights that Tesla's business model is also tapping into areas beyond initial vehicle sales, providing a strong foundation for future profitability. All in all, these numbers tell us one thing. Tesla isn't just weathering the storm, it's thriving. With growth across multiple segments and a clear edge in regulatory credits, this Q3 report isn't just a blip, it's a sign of Tesla's resilience and potential. And we're only scratching the surface. Stick around because as we dive deeper, you'll see why this Q3 report could be the catalyst for something huge. Now, let's dig into one of the key elements that pushed Tesla's profitability higher this quarter: regulatory credits. Tesla managed to pull in a hopping $739 million from these credits, a revenue stream that's often overlooked but plays a crucial role in boosting its margins. Here's how it works. Automotive companies are required to obtain a certain amount of regulatory credits to meet emission targets. Since Tesla exclusively produces zero-emission vehicles, it has an excess of these credits and can sell them to other automakers struggling to meet their quotas. This quarter, these regulatory credits weren't just a bonus, they were a substantial profit driver, helping Tesla maintain strong margins even as it faces intense price competition. Regulatory credits might sound like a technicality, but they're effectively free money for Tesla, giving the company a unique advantage in the industry. And with $739 million in credit revenue this quarter, Tesla is showing that it knows how to capitalize on this edge. But this advantage may not last forever. As competitors ramp up their own electric vehicle production, they may need fewer credits from Tesla, potentially affecting future revenue. Yet for now, Tesla's mastery in leveraging regulatory credits is a powerful tool, keeping profitability strong even as the EV market grows more competitive. Could this revenue stream continue to be Tesla's secret weapon in the years to come? Let's keep going to see what other strengths Tesla is bringing to the table. Beyond automotive sales, Tesla's Q3 report revealed a massive surge in its energy generation and storage business, a segment that's growing at an astonishing rate. Tesla reported $2.38 billion in revenue from this area alone, up 52% from last year. This is a significant leap and shows how Tesla's ambitions extend far beyond the electric vehicle market. One of the biggest contributors to this growth is Tesla's Megapack, a utility-scale battery designed to store renewable energy for large projects. With the Megapack reaching full production capacity, Tesla is capturing demand from utility companies and governments seeking to stabilize their energy grids with sustainable solutions. In fact, Tesla's energy storage products are now so popular, they're essentially sold out for the next year, underscoring just how high the demand is. This isn't just a side business for Tesla, it's a key part of its strategy to diversify revenue streams. By expanding into energy generation and storage, Tesla isn't relying solely on car sales. It's positioning itself as a leader in the global transition to renewable energy, which could open doors to even more revenue and potentially insulate it from the ebbs and flows of the automotive market. This success in the energy sector is another reason why Tesla's Q3 report is such a big deal. It signals that Tesla is moving closer to becoming an all-encompassing energy powerhouse, not just a car company. Could this pivot be what ultimately drives Tesla's stock to new heights? There's more to uncover, so let's dive deeper into Tesla's next game-changing move. Tesla's ambitions don't stop at energy storage. They're also doubling down on autonomous driving technology, which Elon Musk sees as the future of the automotive industry. During the Q3 earnings call, Musk projected vehicle growth of 20 to 30% for Tesla in the coming year, driven largely by lower-cost models and advancements in autonomy. Tesla is betting big on the idea that fully autonomous vehicles will reshape transportation, and they're preparing to be at the forefront of that change. According to Musk, Tesla's focus on autonomy means that every car they produce is capable of autonomy, setting the stage for a future where Tesla cars drive themselves. He even hinted that Tesla is currently making around 35,000 vehicles per week with autonomous capabilities built in. This isn't just about adding a cool feature. It's a strategic move to position Tesla as a leader in self-driving technology with potential for enormous revenue through autonomous ride-hailing services or robotaxis. But Musk didn't stop there. He revealed plans for Tesla to offer driverless ride-hailing services as early as 2025, starting in Texas and California, where they're already testing a ride-hailing app for employees. Imagine summoning a Tesla without a driver, taking you wherever you need to go. That's the vision Tesla is pushing toward, a future where owning a Tesla means access to a new autonomous mode of transport that could change the way we think about car ownership. If Tesla can successfully roll out autonomous vehicles on a large scale, it could redefine the company and even the broader transportation industry. This ambitious goal is one of the reasons why Tesla's Q3 earnings report has investors so excited. But can Tesla really pull it off, and what challenges might lie ahead? Stick around as we delve into how this bold move could be a game changer. Now let's talk about one of Tesla's biggest hits this quarter, the Cybertruck. After years of anticipation, Tesla's futuristic angular pickup truck finally hit the market, and it's already making waves. According to Tesla's report, the Cybertruck has quickly become the third best-selling fully electric vehicle in the US, right behind the popular Model 3 and Model I. Even with some initial quality concerns, Tesla managed to sell over 16,000 units in just the third quarter alone. What's particularly impressive here is that the Cybertruck has already achieved a positive gross margin. In the auto industry, launching a new vehicle often comes with high upfront costs and can take years to become profitable. Tesla, however, has managed to get the Cybertruck in the black from the start. This success speaks volumes about the demand for this model, and it signals that Tesla has hit on a winning formula with its unique design and the Cybertruck's appeal to a niche but passionate market. This isn't just another vehicle in Tesla's lineup, it's a statement. The Cybertruck shows that Tesla isn't afraid to push boundaries and disrupt the status quo in the automotive industry. And beyond the hype, the positive gross margin points to the potential profitability of future Cybertruck production as Tesla scales up. With the Cybertruck's initial success, Tesla is proving it can turn unconventional ideas into real market successes. But can Tesla keep up with demand? And will the Cybertruck maintain its appeal over time? We'll explore how this bold product fits into Tesla's broader vision and how it could affect the company's bottom line. As Tesla rides high on its recent wins, it's also facing intensifying competition in the electric vehicle market, especially from formidable players in China like BYD. BYD recently outpaced Tesla in quarterly EV sales for the first time, a significant milestone in the global EV race. Chinese automakers like BYD, Li Auto, and NIO are aggressively capturing market share with models priced lower than Tesla's, making them especially appealing to cost-sensitive consumers. This surge in competition has pushed Tesla to respond with price cuts and added incentives to stay competitive. In China, the world's largest EV market, BYD's dominance is rooted in its ability to produce affordable yet innovative electric vehicles, with some models priced as low as $20,000. For comparison, Tesla's entry-level models are significantly pricier, making it challenging for Tesla to attract the broader consumer base that BYD and others are targeting. This intense competition doesn't just impact Tesla's sales, it pressures their profit margins as price cuts to stay competitive have already eroded some of Tesla's profitability in recent quarters. But competition isn't limited to China. Traditional automakers like Ford and General Motors in the US are also ramping up their EV production, even as they refine strategies and offerings to challenge Tesla's market share in the West. With these companies aggressively pursuing electrification, the EV market has never been more crowded. Tesla, known for its premium brand appeal, may find itself in a balancing act between maintaining profitability and adjusting prices to stay relevant. Can Tesla continue to hold its ground as new players flood the EV space? Will the brand's premium appeal be enough to counter the price wars and the influx of affordable models? As we'll see, Tesla's response to these pressures could be critical in shaping its future trajectory in the EV market. Tesla's competition isn't the only factor influencing its brand. Elon Musk's high-profile political stances and activities are also having a significant impact on consumer perception, especially in key markets like California. Musk's outspoken support for former President Donald Trump, coupled with his increased political involvement, has sparked mixed reactions among Tesla's customer base. Recent surveys show that a sizable portion of potential buyers, especially in more progressive states, are reconsidering their purchase decisions due to Musk's political alignments. In California, where Tesla historically dominates EV sales, the company has seen a decline in its market share. Many loyal customers are expressing frustration, not only with the political stance, but also with what they perceive as a shift in Tesla's brand identity under Musk's leadership. Some have even switched to competitors like Rivian or Hyundai, citing Musk's personal controversies as a key factor in their decision. This growing disconnect between Musk politics and Tesla's customer base poses a unique challenge. On one hand, Tesla remains a leader in innovation and continues to produce highly sought-after products. On the other hand, Musk's public persona may be alienating certain segments of consumers, particularly those in left-leaning areas who may feel less aligned with his recent choices. Will Musk's political involvement ultimately impact Tesla's long-term sales, or can the company's innovations continue to carry it forward despite these challenges? Let's dig further into how investor sentiment is shaping up amidst these shifting dynamics and what it means for Tesla's stock trajectory. Despite the mixed signals surrounding Tesla's brand and increasing market competition, investor sentiment after the Q3 earnings released has been surprisingly optimistic. Tesla's stock jumped 12% in after-hours trading, showing that many investors still have strong confidence in the company's future potential. Analysts are closely watching how Tesla will navigate its current challenges, and while some are cautious, others believe that Tesla's long-term growth story remains compelling. Dan Ives from Wedbush Securities, for instance, highlighted Tesla's resilience in his note to investors, pointing out that the company's ability to stay ahead on technology and scale is key to its sustained market appeal. Investors also seem encouraged by Tesla's recent product expansions, like the Cybertruck and energy storage solutions, which suggest new revenue streams that could insulate Tesla from some of the competitive pressures in the EV market. However, the political and brand-related risks aren't entirely lost on the investment community. Some investors have raised concerns that Musk's polarizing public image could have a lasting impact on consumer sentiment. But for now, the majority view seems to be that Tesla's innovations and global footprint provide a buffer that keeps investors excited about the company's future. What do you think? Is Tesla still a top pick in your portfolio, or are you skeptical about the impact of these recent developments? Share your thoughts in the comments, and let's dive into the big picture of where Tesla's stock might be headed in the near future. So, after examining Tesla's Q3 earnings and the factors driving both optimism and skepticism, what's the verdict? Tesla's latest report shows a company that's not just surviving, but thriving in a highly competitive and unpredictable market. With strong growth in profit margins, an expanding footprint in energy storage, and a bold vision for autonomous driving, Tesla is positioning itself as more than just a car manufacturer. It's evolving into a multifaceted technology and energy powerhouse. Of course, challenges lie ahead. Competitors like BYD and traditional automakers are closing the gap, and Musk's public persona is creating brand image concerns, particularly among certain consumer segments. But if Tesla can keep pushing innovation forward with autonomous vehicles, driverless ride-hailing, and advanced energy solutions, the company could be on the brink of a groundbreaking transformation that may propel its stock to new heights. For investors, the potential here is enormous, though it's not without risk. As Tesla moves toward its ambitious goals, its success could signal one of the most remarkable stock surges of our time. And as always, remember, this video is for informational purposes only. It's not financial advice. Don't forget to subscribe for the latest insights on Tesla's journey and stay tuned for what's next on this thrilling ride.